Quick reminder from the last video I said you might be losing money just by letting it sit in the bank. The biggest reason is inflation. Today I'll explain it as simply as possible. What inflation is, why it eats away at your money, and most importantly, practical ways to protect your buying power. Everything I share is stuff I pulled together from around the web, so if anything needs correcting or adding, drop a comment below and let me know. First, for anyone who doesn't know what inflation is when the average level of prices goes up over time. For example, last year a haircut was $50. This year it's $80. In economics, people point to a few causes: demand outstripping supply, rising input costs for businesses, or there being more money in the system than goods to buy. Demands matter too. If everyone expects prices to rise, businesses raise prices faster. Look at OnlyFans revenue, and you get the idea. But you don't need an economics degree to get this. Inflation means your dollar buys less over time. Everything that follows in this video is built on that simple fact. The easiest formula you'll ever need. Real return equals nominal return minus inflation. So, if your bank pays 1% per year but inflation that year is 4%, then your real return is about 3%. Your balance goes up, but your buying power drops. Sounds small, but it hurts, right? All right, now the main part of the video, how inflation affects your money and what you should do. I'll break it into 3 time frames: short term, medium term, and long term, and do a few side hustles to boost income. First, short term is emergency money and cash you'll need in the next 0 to 3 years. The rule is liquidity matters most. If you shove your emergency fund into risky assets, you might earn a few extra percent, but you also risk losing it all. Generally not worth it. But also don't let the cash sit and get eaten by inflation. So what you want to do is keep 3 to 6 months of living expenses in an accessible account, but choose ones that pay better, like high-yield savings or online money market accounts. Still safe, but pay better than traditional checking. If you won't touch that money for a while, consider short-term CDs or short-duration bond funds. They usually pay more than a basic savings account, but may lock your money for a bit. Or do a CD ladder, split money into multiple CDS with different maturity dates, so you always have some cash rolling back and get better average yields. So yeah, protect liquidity first, then optimize for the highest safe yield. Remember, safety and access are more important than trying to beat inflation with your emergency fund. For medium-term goals like a down payment or renovation, typically 3 to 10 years, you want moderate growth but protection if markets wobble. Reasonable options you can consider: short to intermediate term bond funds, TIPS, it means like this, or a CD ladder that matches your timeline. TIPS adjust principal with inflation, which is great for protecting purchasing power. Short-term bonds reduce sensitivity to interest rate swings compared to long-term bonds. If you're not comfortable picking bonds, consider balanced funds or conservative target date funds. These mix stocks and bonds to reduce volatility while offering some growth. The key is matching risk to when you'll need the money. Next, we have long-term investing. Long-term money like retirement or building wealth. Stocks are usually the main tool. Over decades, the stocks tend to beat inflation because companies can raise prices and grow profits. Index funds or ETFs are the easiest, cheapest way to capture that growth. Real assets like real estate, REITs, means like this, or commodities can also hedge inflation long-term because their values often rise with prices. However, real assets can be illiquid, costly, and sometimes underperform. So, diversification matters. A simple long-term plan many people use: a mix of low-cost stock index funds plus some real assets exposure plus periodic rebalancing. That tends to beat inflation over time. All 3 investment approaches above emphasize safety overall. Short and medium-term options mainly help your money keep pace with inflation. If you have long-term capital in real estate, congrats. You've got a passive income source that generally rises and can even rise a lot. If you don't have money for real estate, you can invest in side hustles or e-commerce like Shopify, Etsy, open a store, run ads. Side hustles don't need much money or time, so they're absolutely a worthy option. Now, quick on specific tools. We have this realistic list. I bonds, it's government savings bonds linked to inflation. Preserve buying power, but there are purchase limits and rules to check. Tips. Treasury inflation protected securities. Adjust with CPI and protect real value. Good for the medium term. Short duration bond funds. Less interest rate risk than long-term bonds. Floating rate notes. Coupons reset with the market. It's helpful if rates are rising. Dividend-paying stocks and index funds. They are for long-term growth. Real assets like property, REITs, commodities, diversify against inflation. These require a lot of money. CD ladder. Different maturities to manage rates and liquidity. Each tool has trade-offs: liquidity, taxes, fees, and risk. So choose something that fits your timeline and risk tolerance. To make it practical, here's a simple rule of thumb. 0 to 3 years, mostly cash and very short-term instruments. High-yield savings, short CDs or side hustles. 3 to 10 years, short medium-term bonds, some inflation-protected assets, and a bit of conservative stocks. Or side hustles. 10 plus years, mostly diversified equities plus some real assets, real estate and strategic bonds. You can still do side hustles. Important things? Say them 3 times. The reason I mention side hustles so much is because they're a kind of investment that doesn't cost a lot of money or time but can make a breakthrough. So instead of leaving money in the bank, invest it. Remember to adjust the mix by your risk tolerance, but always separate emergency cash. Quick point on bonds. Duration equals sensitivity to interest rates. The longer the duration, the more a bond's price falls when rates rise. So when you worry about inflation increasing, long-term bonds usually get smashed. That's why many people choose short-term bonds or TIPS. One interesting thing, inflation can help borrowers. If you have fixed-rate debt like a mortgage, inflation reduces the real value of those future payments, so borrowers can benefit to some extent. That's why people sometimes rush into fixed-rate loans when rates are low. Don't forget taxes and fees. Inflation can create nominal gains that get taxed even if your real purchasing power didn't increase. Use tax-advantaged accounts like IRAs or 401k when suitable, and keep fees low. Fees compound over time like termites eating your returns. Protecting money isn't just about investing, it's also about spending smarter and increasing income. Negotiate raises, find extra income, and automate savings. If your income grows faster than inflation, you're in a much better spot. Simple steps. Ask for a raise, though you'll often get turned down. Upgrade skills, find passive income streams, invest and reinvest continuously. Diversify and rebalance. Diversification spreads risk across stocks, bonds, and real assets. Rebalancing, selling what's up and buying what's down, helps you buy low and sell high over time and keeps risk steady. This is simple, so I'm pretty sure everyone already knows it. If inflation is rising, you can shorten bond duration, increase exposure to inflation-protected instruments, or add real assets. Don't overreact. Market timing is risky. A steady plan beats panic. Here's a 1-week checklist you can do right now. Move emergency cash to a high-yield savings account. Check your bond holdings, like cut long-duration bonds if you're worried about rising rates. Open a small position in inflation-protected instruments, like I bonds or TIPS. If it fits your timeline, automate investing into low-cost index funds for long-term goals. Reduce high-fee accounts and useless subscriptions. But keep Netflix, ask for a raise. Not recommended because you're often going to be turned down. Side hustles, highly recommended because they cost little and you gain experience, Plus, there are many ways to make money online these days. When money becomes hot, scammers show up. Big return promises, tiny investment required, guaranteed returns. Do 15 minutes a day and make $1,000. In this world, easy money is only rain and bird poop. In a nutshell, inflation reduces purchasing power. For short term, keep money safe. For medium term, tips and short bonds. For long term, stocks and real assets. Plus, cut fees, increase income, do side hustles, and rebalance. And yeah, that's all I was able to dig up online. If this video was useful, remember to like, comment the price that surprised you most recently, and subscribe to get simple drawn finance videos every week. Peace.